Hello and welcome. You're with us here on Business Today. I'm Abha Bakaya. Here are the top stories. From new income tax regime to no LTCG benefit on debt mutual funds, India will see 9 major direct tax changes from April 1st, 2023. Adani Group stocks hit hard. Group market cap drops 80,000 crores to under 9 lakh crore in 3 days. EPF raises interest rates to 8.15% from 8.1% earlier on employees' provident fund deposits for 22-23. The deadline to link PAN with Aadhaar has been extended to June 30th, 2023. World Bank in its latest report has warned that global economy's growth rate is set to plunge to a 3-decade low. Taxpayers are set to witness major changes from April 1st, 2023, starting with the new income tax regime to no LTCG benefit to debt mutual funds. There are 9 key changes that will impact income taxpayers and investors. Here's the report.
Now I come to what everyone is waiting for. Personal income tax. I have 5 major announcements to make in this regard. These primarily benefit our hard-working middle class. First one concerns rebate. Currently, those with income up to 5 lakh do not pay any income tax in both old and new regimes. I propose to increase the rebate limit to 7 lakhs.
These lines from Finance Minister Nirmala Sitharaman made headlines in India. In a budget speech on February 1st, Finance Minister laid down the financial plans for country for 2022 and 23 and announced significant changes in the tax rules. Those will be applicable from April 1st. These changes include the new income tax regime and absence of some tax benefits on debt mutual funds. Here's more on the changes taxpayers and investors should note. For starters, the new income tax regime will be the default regime. Taxpayers will be given a choice to choose their regime. In case they don't, the income tax will be calculated as per the new regime. Tax rebate under Section 87A will be hiked to taxable income level of rupees 7 lakh from rupees 5 lakh. And the amount of tax rebate has doubled to 25,000 rupees. There are also changes in income tax slabs. The Union Budget 2023 tweaked the tax slabs under the new income tax regime. There will be no tax if you earn up to rupees 3 lakh. From 3 to 6 lakh rupees, tax rate is set at 5%. And for rupees 6 lakh to rupees 9 lakh slab, tax will be 10%. And 15% tax will be levied on earnings of 9 to 12 lakh. Next slab from 15 lakh will be taxed at 20%. Investors should also note that the long-term capital gains provision and 20% tax with indexation benefit will not be available on debt mutual funds. The existing investments will continue to get this benefit. From April 1st, 2023, proceedings from life insurance premiums over the annual premium of rupees 5 lakh would be taxed. Starting this Saturday, the leave encashment allowance for non-government employees will be exempted up to rupees 25 lakh. Earlier, it was just rupees 3 lakh. Finance Minister Nirmala Sitharaman during a budget speech said that there will not be any capital gain tax if physical gold is converted to an electronic gold receipt and vice versa from April 1st, 2023. The budget also reduced the highest surcharge rate from 37% to 25%, high net worth individuals who would choose the new tax regime.
Is regarding the highest tax rate, which in our country is 42.74%. This is among the highest in the world. I propose to reduce the highest surcharge I propose to reduce the highest surcharge rate from 37% to 25% in the new tax regime.
Finally, the taxation of market-linked debentures will be short-term capital assets. Market-linked debentures are non-convertible in nature, where the returns are not fixed but linked to the market. With this rule, grandfathering of early investments will end and the impact on the mutual fund industry will be slightly negative. Bureau Report, Business Today Television.
Retirement Body Fund, Employees Provident Fund Organization, has fixed the Employees Provident Fund or EPF for the current financial year 22-23 to 8.15%. The fresh rate is only marginally higher from 8.1% last year, which was the lowest in almost 4 decades. This comes as a disappointment to EPFO subscribers who've seen the interest rate decline sharply over the past couple of years. According to the Ministry of Labour and Employment, EPFO has added 1.48 million subscribers in January this year. There are over 67.8 million members contributing to EPF who will get the benefit of the marginal hike. The board's recommendation will involve distribution of more than 90,000 crore rupees to EPFO members. While Indian markets ended the range-bound session lower ahead of expiry tomorrow, it was the Adani Group stocks which were hit hard. After recovering sharply since February 27th low, shares of the Adani Group companies saw an 8.23% erosion in market capitalization in a fresh bout of selling. In the 3 sessions to Tuesday, as the group market cap dropped 80,000 crores to under 9 lakh crores as compared with 9.7 lakh crores on 23rd of March. The worst performing Adani Group stock was NDTV, which plunged 13.7% in the 3-day period. It was followed by Adani Power, down 13.59%, and Adani Wilmar, down 12.6%. Ambuja Cements was also down 3.5%, Adani Green Energy 4.78%, and Transmission about 6%. The group shares fell amid reports that raised questions about whether the group actually has repaid debts worth $2.15 billion. The Adani Group had earlier this month announced completion of the full prepayment of margin-linked share-backed financing ahead of the committed timeline of March 31st. We're almost at the end of the financial year, and despite a rather eventful one, Indian markets have largely outperformed the world. My colleague Sakshi Batra joins us for a roundup of the year that was.
Well, Abba, what an eventful financial year this has been so far. Everything that could perhaps go wrong did for the Indian markets. And we had COVID, Russia-Ukraine war, the European energy crisis, globally a red-hot inflation and the aggressive rate hikes. And also, the global markets did feel the pressure of all of this and more in this financial year. From the US markets to Japanese markets to China to India, most of the world markets corrected in financial year 2023. Let's take a look at the worst performers, in this year. We did have the US markets falling the most, 17.2% right there, 12% of a fall for S&P 500. India was somewhere in between with 2.7% cuts, and the least fall was recorded in the Chinese market. The Shanghai market corrected by 0.2% this time around. Now, coming to the Indian markets specifically, it was the broader markets that underperformed this year, with the small caps correcting the most, over 6%. But if you were someone smart who invested heavily in banks, you would have made good money. The Nifty Bank really outperformed this year with over 8% gains. Now, we also saw no support really coming in from the FIIs, who really sold nearly 40,000 crore rupees worth of stocks in the Indian equities. However, on the other hand, we did see domestic investors that supported, and how, as they invested over 2.5 lakh crore rupees in FY23. Now, when we also talk about the sectors, it was the capital goods, the FMCG sector and the auto sector which actually came out as clear winners in FY23, clocking in gains anywhere between 15 to 23%. So that's the kind of gains that you saw. On the other hand, IT, realty and metal sectors lost most of their sheen as they were the weakest this time and fell anywhere between 16% to 24% this time around. Now, among the index movers and shakers, the big surprise came in from the top Nifty gainer this time around. Any guesses? Well, it was this stock of ITC. The most memed stock, perhaps, of the past was the top Nifty gainer, followed by M&M and Britannia. On the other hand, you did see IT majors, Wipro, the pharma major Divis Laboratories and the metal counter Hindalco that were the top Nifty losers and saw sharp cuts of anywhere between 31 to 39% this year. It was indeed very difficult to make money as an equity investor in FY23. But if you were a smart investor, there were enough opportunities. Now, some of the dark horses from the broader markets gave you multi-bagger returns of 100 to even 160%. Clearly, a year where individual stocks made investors richer than index investors.
And now to understand what FY24 has in store for investors, for this, we're joined by Ashish Somaya, CEO, White Oak Capital. What do markets hold for us as we head into a new financial year? What is the second half of the year particularly going to look like in 2023? Let me welcome in Ashish Somaya, who's joining us to give us the perspective. Ashish, given the turbulence and the volatility we've been seeing, whether it be with the global backdrop and all of the mixed cues coming in there, or even whether it be certain triggers back home, it has been quite an uncertain time for markets. What are the expectations you have from the new financial year?
I believe that the second half of 2023 is likely to be much better than what we've seen for all of 2022 or even the first 3 months of 2023. I think the uncertainty or whatever you described, in terms of global factors, more specifically the US Fed stance, likelihood of them stopping the interest rate hikes. And I think, some kind of settling down as far as US financial market conditions are concerned. I think next 2 to 3 months will still have a lot to watch out for. But if you really ask me, I believe that the second half of 2023 is likely to be much better than the last 12 to 15 months.
All right, so you're actually expecting it to be better. Ashish, it's interesting because we're also, with this heightened rate hike scenario, do you see any kind of delayed reaction coming in for Indian markets, whether it be to news from overseas or whether it be in terms of the kind of pinch we're going to feel on the back of those heightened rates?
No, see, I think we've already been through a lot because, if you really look at it, where did all of this start? If you look at end of 2021, first we heard about, the Chinese tech sector kind of collapsing and Chinese real estate and those kinds of things. That is where the market turmoil actually started. And then, January, February of 2022, we saw, the war starting and then, commodity prices, inflation, US interest rates, etc. Long story short, all through this period, our fundamentals and our domestic performance has been relatively stronger. In the last 18 months, while index has gone nowhere, the fact is that at an index level, the earnings per share has gone up by about 20-odd%. And if I talk like people like us, who don't look at just earnings per share, we look at free cash flow. Portfolios have seen free cash flow rise by about 30-40%. So I think our fundamentals and domestic conditions have been relatively stronger, but we have actually been seeing that our market is going nowhere purely on account of external macro conditions. And I think that the next couple of months or next 2-3 months, like I mentioned, is going to be like a culmination of sorts of all those external disturbances. And I think the worst will hopefully be behind us. That's what we're likely to witness.
Great. So what's a good strategy to look at right now in terms of investing, whether it's looking for value in the market or whether it's themes that you feel will continue or grow stronger in the second half of the year?
Yeah, I think what's top of mind for me right now is, typical investor behavior, because what happens is if you look at, say, I'm part of the mutual fund industry, and if you look at equity mutual funds and the flows or the confidence with which people were investing in equity funds, I think the peak was 2021. So if you look at end of 2021, in any given month, we were witnessing as high as 60 to 70,000 crores of rupees being deployed into India's equity mutual funds. And that was on the back of very strong performance in calendar 20 and calendar 2021. Now, 2022 obviously has not been a good year. And, for factors we discussed, people haven't made much of a return. So typically what happens is that if you have a year or 18 months where people don't make return, then their level of confidence or their motivation levels to keep investing kind of goes down. And the number which was 65-70,000 crores a month has now dropped to about 30-35,000 crores per month. So there's a 50% decline in how much people were investing in stock markets or especially in equity mutual funds. Now, my past experience tells me that your current level of confidence in investing has nothing to do with what kind of return you will make in future. In fact, if there's anything, it is inversely proportional. So people feel very confident when the recent return has been good, which means probability of return in near future tends to go down. Whereas people feel very underconfident when the recent return is bad. And from that point, actually, the probability is that you will make very good return.
All right, Ashish, we'll leave it there. Thanks so much for joining us and chatting with us today.
Thank you.
The global economy's growth rate is set to plunge to a three-decade low of 2.2% a year by 2030. The World Bank has warned in a new report, adding that nearly all economic forces that powered progress and prosperity over the last 3 decades were fading. A lost decade could be in the making for the global economy. World Bank's chief economist Indermit Gill has said as a result, between 2022 and 2030, average global potential GDP growth is expected to decline by roughly a third from the rate that prevailed in the first decade of this century to 2.2% a year. The World Bank added, for developing economies, the report said the decline will be equally steep from 6% a year between 2000 and 2010 to 4% a year over the remainder of this decade. These declines would be much steeper in the event of a global financial crisis or recession. In January this year, the IMF said the global economy was poised to slow before rebounding next year. With FY23 set to end this Friday, the central government is expected to achieve its revised target of 93,000 crore rupees for disinvestment proceeds, including dividends. My colleague Karishma Adani joining us with more on this. Karishma, how's the graph looking, especially with key stake sales that have been in the pipeline?
Well, absolutely. Run up to the next fiscal year, we are talking about the much-awaited disinvestment target. But now, if you see it from a broader point of view, it actually is more of a situation that's well balanced when you talk about between dividends and divestment receipts. In fact, while the dividends have surpassed its revised target of 43,000 crore that government had estimated in budget, it's the divestment receipts which are still lying low at close to 34,000 crore versus 50,000 crore that government was confident of achieving. It's of course because of the downfall that it had to see because of the market sentiments with the LIC, with IDBI, and also what recently happened with Hindustan Zinc.
Right. Karishma, what's the update on IDBI Bank particularly? Give us a bit more detail. What's the centre's plan of action there?
Well, right, debunking all media reports, Deepam had in fact last week mentioned that the process is on track, and we have learned exclusively from our Ministry of Finance sources that financial bids for IDBI Bank could be called in by June. In fact, they're looking to announce it any time between May and June, from 2 to 3 months from now, and post that, of course, parallelly security clearances will be taken. Now, this is first of its kind transaction. Since it involves a bank, it will require a fit or proper criteria to be given by Reserve Bank of India before Deepam opens the data room for bidders to, of course, access all the information. The government and LIC both are looking to sell close to 60% stake together, 30 each, and they are pretty confident that in the coming fiscal they'll be able to execute this transaction.
All right, Karishma, thanks so much for joining us with that. Now, the process for disinvestment of the Ashok has moved a step ahead, with the government beginning the preparation of model concession agreement for the iconic Central Delhi landmark property. BTTV's Chetan Bhutani joins us with more on this exclusive story. Chetan, what's the latest in what's been a long-drawn saga with regards to Ashok Hotel?
Well, absolutely, Ava. It's literally a long-drawn saga, 2023, but now seems to be the year when ITDC's iconic property, the Ashok in Delhi, goes on a long lease for about 60 years. Sources have in fact told Business Today TV that the government has in fact expedited the process, and the structural audit of both Ashok Hotel and Samrat Hotel have begun and will be completed in 6 months. Sources also confirming to Business Today TV that the process of formulating the model concession agreement, which literally forms the backbone of any disinvestment, has also begun, and the day it receives green light from the Union Cabinet, the government will call the bids and will not wait any further. Remember, the Ashok is a 550-room hotel built on a sprawling 25-acre land in the heart of the national capital.
All right, Chetan, thanks so much for that. Now, will electric vehicles become cheaper given that prices of key battery inputs like lithium, cobalt, copper are all coming down? Chetan also sat down with Akshay Singhal, founder and CEO at Log9 Materials, on future EV price trends. Listen in.
We've been observing that the benchmark, as the benchmark minerals, in fact, there has been a fall in lithium prices by nearly 20%. We are seeing cobalt prices more than down by 50% and copper prices down by 18%. What does it entail for India's electric vehicle manufacturing story, and especially the batteries, who form the most critical part for these three items?
See, the point is, in particularly, and always a pleasure talking to you, Chetan. But if you look at these fall in prices, right, I don't think it impacts significantly in a very short term as far as the Indian market is concerned, right? Because we typically in India procure cells which are manufactured outside, and we procure them as an extra inventory which the various cell manufacturers have, right? We are not at a scale in the Indian ecosystem where we have dedicated orders with the cell manufacturers so that the recent drop in price or change in prices gets affected into the cell procurement cost.
For electric vehicle manufacturers and OEMs especially, and companies like you who are indigenously manufacturing batteries in India, I'm sure you also somehow use these products as well. Are you seeing the prices coming down for your own batteries?
So yes, but not immediately. As I said, that we in India, given that we have a small pickup coming to the country, the impact of these prices or price reductions will take shape or will basically provide us a benefit over at least 2 quarters, right? And for that, the price have to remain where they are now, right? So, but yes, what the chatter that I'm hearing in the industry from our suppliers and otherwise is that yes, there is an expected reduction in prices. So yes, overall it could be beneficial for the entire ecosystem, but it will take some time before it gets realized on ground.
So you're saying it will take time to reflect of the prices coming down, but are you anticipating these prices to be down for like a longer time, or do you think when the geopolitical tensions improve, it would subsequently go up, and again lithium would be called a white gold and it will continue to be expensive?
See, if I take a 10-year view or 20-year view, right, the prices will come down, right? If you look at the overall production cost of lithium is not that high, right? And I was just reading it today or day before about so if you look at the processing cost is sub $7,000-8,000 per ton, whereas the benchmark price is around $40,000-50,000 per ton right now. So there's a significant difference between the cost of processing versus the, so to say, LME pricing, right? So there is definitely overall in a 10-15 year kind of horizon, the prices will and have to come down, and that's how the EV industry or the battery industry will grow. But in the next 4 or 5 years, because there is huge capacity enhancement on the battery manufacturing side, cell manufacturing side, and then it has to match up with the overall capacity on the mining side and all of those things. So these prices will continue to keep going up and down.
Business Today is back with the 20th edition of the Most Powerful Women Awards. Here's what you can expect as we celebrate at BT's prestigious annual event tomorrow. Role models in the world of business will be coming together.
In 2003, Business Today was a trendsetter. The first to create the Most Powerful Women Business Awards in India. For 20 years, BT has recognized India's most successful and influential women entrepreneurs and business leaders. Zia Modi, Swati Piramal, Kiran Mazumdar-Shaw, Renuka Ramnath, just a few among 200 leaders honored by BT. All champions, best in class, creators of jobs, drivers of wealth and shareholder value, delivering hope and inspiration, icons all, feted by some of the most powerful global business leaders. Meg Whitman, Shelley Lazarus, Indra Nui, Ellen Kullman, Sarah Matthew, Chua Sok Koon, Ursula Burns. Business Today's Most Powerful Women charts a journey that has mapped the ebb and flow of Indian business's better half. A remarkable journey of grit, staying power, leadership acumen, and the rise of gender parity. A group of women leaders with achievements unparalleled, courage undiminished. Vision unmatched. It's time to rejoice their achievements and learn from their success. A journey that continues till today and will continue in the coming years. Today we recognize the class of 2022 of the Business Today Most Powerful Women in Business.
Do stay tuned for that tomorrow. For now, it's goodbye from all of us here at Business Today. Thanks for watching.